Okay, let's dive in. Every business out there, I mean, whether it's a huge corporation or, a tiny local shop, is built on a financial structure.
Mm-hmm.
Today, we're decoding the visual map of that structure.
Yeah.
Cost volume profit analysis, CVP.
Right. And you've probably seen these charts before, maybe in a business class or something.
Exactly. But our mission here isn't just to define the lines on a graph. We want to get at the strategy behind them, the hidden choices about risk and reward that are all mapped out in this really fundamental model.
It's so true. I mean, CVP is the blueprint.
Hmm.
If you want to understand why one company just explodes with profit when sales go up and another just kind of plods along,
Yeah.
the answer is almost always in their CVP structure. We're looking at how three core costs, fixed, variable, and total, how they interact with volume to hit that all-important tipping point,
Profitability.
profitability.
And what's so useful about this whole model is that we're generally assuming a world where things are pretty straightforward.
Right.
Within a certain range of operations, at least, everything's a straight line. That linear assumption is what makes it so clean to look at.
That's the magic of it, really. It
Yeah.
smooths out all the operational bumps so you can see the relationships clearly. Of course, if you suddenly buy a second factory, well,
The model changes.
the whole model changes. But within your current capacity, those lines are incredibly reliable guides.
Okay, so let's start with the standard CVP graph. If you're picturing this, the horizontal axis, the one at the bottom, that's always volume.
Right. The number of units you make or sell.
And the vertical axis going up the side is just money, dollars.
Always dollars. It's where we start building the whole cost structure right from the ground up.
Yeah.
And the very first, most stable piece of that is your fixed costs.
Your rent, insurance.
The CEO's salary.
Yeah.
All the costs that are there even if you sell 0 units.
Which is why it's a perfectly flat, horizontal line on the graph. It's the baseline cost of just being in business.
It doesn't budge. 0 units, 100,000 units, it stays the same. The whole area under that line visually represents the cash you're burning just to keep the lights on.
Then you bring in the other side of the coin, revenue.
Yep. And that line always, always starts at the origin. Dead center. 0, 0.
Makes sense. Sell nothing, earn nothing.
Exactly. But as soon as you sell that first unit, that line starts sloping up. And fast.
And that slope is basically your selling price, right? Each unit sold makes the line jump up by that amount. It's a pure, clean climb from 0.
Now for the most important line, I think, total costs, this is where the fixed and variable worlds collide.
Okay.
Since you have those fixed costs even at 0 volume, the total cost line can't start at the origin like revenue did.
Ah, right. It has to start higher up.
It starts at the exact same point on the vertical axis where
Yeah.
your fixed cost line began.
So it's already got a head start on the revenue line. It starts high, and then it also starts to climb.
And that climb, that slope above the fixed cost baseline, that is all variable cost.
Raw materials, commissions.
Direct labor, costs that move in lockstep with volume. You sell 1,000 units, variable costs are high. You sell 1, they're low. The steeper that total cost line is, the higher your variable cost per unit must be.
So when you put those 3 lines on the chart, revenue, fixed costs, and total costs, you can immediately spot the single most important point in this entire analysis.
The break-even point.
Yes.
It's a beautiful moment where the total revenue line finally catches up to and crosses the total cost line. It's when the business stops paying for itself out of pocket and starts paying for itself with sales.
It really is a line in the sand. Every dollar you make before that point is basically just cost recovery. But every single dollar you earn after that point starts to generate pure profit. The nature of that money just fundamentally changes.
And that defines the 2 massive areas on the chart. Everything to the left of that break-even point where the total cost line is, physically floating above the revenue line.
That's the loss area, the red zone.
Absolutely. The vertical gap between those 2 lines is literally the size of the financial hole you're in at that volume.
And on the flip side, the profit area is everything to the right of break even. The revenue line has finally soared above the total cost line.
And that vertical gap now represents your profit. It's such a powerful way to see your vulnerability, but also, your potential.
But let's say you're a CFO. You don't want to track 3 different lines. You just want the bottom line instantly.
That's where the dedicated profit graph comes in. It simplifies everything down to just 1 line.
I love this way of looking at it. Instead of tracking costs and revenue separately, you just graph net profit directly against your volume.
Precisely. And think about it. At 0 units sold, you haven't earned a penny, but you still owe all those fixed costs. So where does the profit line start?
In the negative. Way down.
Deep in negative territory. Its starting point on that vertical axis is a loss exactly equal to your total fixed costs.
And as you start selling, that single line starts climbing its way back up towards zero.
But it doesn't actually cross that zero line until you hit the exact same volume we identified before,
The break-even point.
the break-even point. So that zero line on this new graph is hugely significant. The area below it is your loss. The area above it is your profit. It just boils everything down. An executive can see the slope, the leverage of their profit engine instantly.
And seeing that single line, how steeply it rises, that really forces you to think about the structural choices you made, which is, I think, the perfect segue into CVP as a real strategic tool. Let's talk about operating leverage.
Yes, this is where the real CVP strategy lives. Operating leverage, or AL, is really just a measure of the financial risk you've baked into your company's cost structure.
It's the trade-off, right?
Yeah.
High fixed costs versus high variable costs.
It's the fundamental trade-off.
Okay, let's break this down with an analogy, because this is where companies make or lose a ton of money. Let's imagine two furniture makers. We'll call them Artisan Works and RoboMill.
Perfect. Okay, so Artisan Works goes for low operating leverage, a conservative structure.
So low fixed cost. They rent a small workshop. Their main fixed cost is maybe just the owner's salary.
Right. But their variable costs are high. They hire skilled carpenters by the hour for every single chair they make.
So if there's a recession and sales just tank, Artisan Works is somewhat protected. Their rent is low and they just stop hiring the carpenters. The financial bleeding slows down almost immediately.
Their profit line is flatter. It's less sensitive to those big swings in volume.
Okay, now compare that to RoboMill. They went for high operating leverage.
They took out a massive loan for a multi-million-dollar automated milling machine. That loan payment is a huge fixed cost. It's due every single month, no matter what.
But their variable cost for each chair is tiny.
Almost nothing. The machine does all the work. They just need someone to push a button.
So this is the classic risk-reward scenario. If RoboMill can just get past their break-even point and then sales surge,
They become profitable so fast. Since variable cost per unit is minuscule, almost every dollar of new revenue past break-even just drops straight to the bottom line. Their profit line has a very steep slope.
wait, so does that mean high operating leverage is just better? It sounds like RoboMill has this massive upside potential.
Oh, they absolutely do. But here's the risk. This is the downside that CVP measures so well. If both companies get hit by a long sales slump,
Uh-oh.
Artisan Works, the low-leverage company, they might just scrape by. But RoboMill, with its high leverage, is going to post huge losses. That giant machine loan chews through their cash every single month, even if they sell 0 chairs.
High fixed costs amplify losses when sales are weak.
They amplify everything. Losses on the downside, profits on the upside. So the choice of operating leverage is really a statement about how much volatility you, as management, are willing to live with.
So high fixed costs is a bet on consistently high volume.
It is. And low fixed costs is a bet on stability and survival over maybe that explosive upside. It's a fascinating strategic choice.
And it connects right into the next challenge. Once you've set your leverage, you have to manage your portfolio of products. Which brings us to sales mix.
Right. Sales mix is just the ratio of what you sell. If you sell tables and chairs, is it 4 chairs for every 1 table? Or the other way around? Because that mix has a huge impact on your bottom line.
And that's because, from a CVP perspective, not all products are created equal.
Not at all. The key metric is the contribution margin. That's the revenue you have left over from a sale after you've paid for all the variable costs associated with it. That margin is what's left to cover your fixed costs and hopefully contribute to profit.
And this is where it gets really strategic. If you're selling a bunch of different products, the core strategy is to push the ones with the highest contribution margin.
Absolutely. Our source material gives a great example. If a product they call Jumbo has a higher contribution margin than the others, management should be pouring advertising dollars into Jumbo.
You're actively managing your CVP. You're trying to adjust the mix to cover those fixed costs as efficiently as possible.
And this is so important for multi-product companies trying to figure out their overall break-even point. You can't just use the simple single product math. You need a few specific inputs.
Okay, what do you need?
You need your total fixed costs, obviously. Then you need the contribution margin for each individual product. But the third piece, and this is the crucial one, you have to assume a constant sales mix.
So you have to assume that 4-to-1 ratio of chairs to tables is going to hold steady.
If you don't, the whole calculation just falls apart.
Let's ground this with some real numbers just to see how it works in practice once you blend all the products together.
Okay, so take the example of a company called Stella Signs. After they blended everything, their total contribution margin ratio, which is just total contribution margin divided by total sales, was 53%.
Which is a really useful number. It tells management that for every dollar that comes in the door, 53 cents is available to cover fixed costs and then become profit.
A 53% ratio is pretty healthy. It means they aren't spending, 80 cents of every dollar just on materials and direct labor.
Right.
And you can use these average ratios to predict the future. We saw another case where a company had an average contribution margin ratio of 66%. With that number, and knowing their fixed costs, they could calculate their break-even point in sales dollars.
And what was it?
It was calculated to be about $151,515.
So that number becomes the North Star for the sales team. It's the absolute minimum they have to hit just to keep the lights on.
Exactly. And you can flip the math to aim for a specific profit goal. If that same company with the 66% ratio wanted to make a target income of, say, $30,000,
Maybe for a bonus pool or an investment fund?
they would need total sales of $196,970.
That's incredibly powerful. CVP isn't just descriptive, it's predictive. It tells you exactly how many sales dollars you need to generate to hit a specific financial target based on your current cost structure.
It connects that big strategic decision operating leverage directly to the day-to-day sales activity. It gives everyone a concrete number to aim for.
So let's bring it all back. We started with the CVP graphs, that foundational map of a business. We saw that the biggest strategic choice is operating leverage.
How much risk you're willing to take on for a shot at high rewards.
And we saw how managing the sales mix is an active strategy, pushing your high-margin products to cover fixed costs more efficiently.
For sure.
But as powerful as all this is, we found that one key foundational assumption that underpins all the multi-product math, both for break-even and for target income, is that the sales mix stays constant.
And that raises a really important final question for you to think about. If your whole budget, your whole forecast, is based on customers buying product A and product B in a perfect 4-to-1 ratio forever, what happens?
What happens to your plan, to that $30,000 target income goal, when a huge consumer trend suddenly shifts?
Huh?
Or a competitor comes in and just guts the price of your high-margin product?
Exactly. How volatile is that constant sales mix in the real world? And what kind of immediate risk does that volatility create? Especially in a business that chose a high-leverage strategy. It forces you to constantly question the stability of your own assumptions.